on how stocks will react no matter what the Fed does. Let's ask Liz Young, SoFi's head of investment strategy, here at Post 9 with us. So we'll get to the quote-unquote rescue of First Republic and the implications moving forward in a moment. But I just want to start with the question of the moment. Should the Fed hike or should it pause?
You know, I've changed my mind about 14 times on that over the last 24 hours. I think the responsible thing to do right now would be to pause, only because I think it looks like if they hike, they are not paying attention to everything else that's going on. However, even if we get a pause, I think they hike again. I don't think that's the end of it. I think we continue to get another hike. The risk here is that I don't think the market likes it either way. I don't think the market likes 25 basis points. I don't think the market likes a pause next week. I think that we are in a state where, once again, we're stuck in this range, and you've got a day where yields are up and growth is up. They can't both win that game. So we've moved into this area where we're waiting for every tiny little piece of news, and I'm worried that we're not, as investors, stepping back enough and looking at the bigger picture, that we've gotten so many bad headlines over the last 5 days that a rally just can't continue at this clip.
No matter what the Fed does.
Well, I think actually some of this rally is predicated on the idea that the Fed might pause and might have to reverse course, and obviously the idea that we've seen some bailouts or some rescues so that there's a backstop again. But the rally, look at what is actually rallying, right? Growth stocks, large cap tech is rallying, the NASDAQ is rallying. It's almost as if investors continue to be conditioned that, okay, rates down, growth is good again, and we can just carry on. What I would warn people about is that if inflation, we still have a 6 handle on inflation, okay? If inflation does stay that high, or if they reverse course before it's fixed, we have a semi-permanent higher cost of capital. That is not good for growth stocks.
There is an idea. We'll get more to the tech trade in a minute, because it obviously has raised a lot of eyebrows over what it's been doing. There is a suggestion that what's happened over the past 5-6 days or so has done a lot of the Fed's job for it.
Sure.
At least in the near term.
Sure.
Eric Rosengren, former Boston Fed president, interest rates should pause until the degree of demand destruction can be evaluated. It undoubtedly, what has happened is a contractionary event.
Yeah,
But, disinflationary, contractionary. So the argument is, why not pause? Take a look around. You don't lose anything. By 25, no 25 for one meeting, big deal.
Well, and that's why I've gone back and forth about should they not. I do think you lose sort of control around the liquidity environment, in the sense of if they do pause, there's a chance that the market really likes it and financial conditions ease on the back of that, which is actually the opposite of what they need to happen for inflation. So, even at the European Central Bank today hiking 50 basis points, their inflation rate is higher than ours right now.
Yeah, I know. Market took that. Look, if you would have told me yesterday, quite honestly, ECB is going to go 50, and we're going to be on the air for closing bell at 3:05, and the S&P is going to be up near 1.5%, the NASDAQ is going to be up 2 1/3%, and the Dow is going to rally by 300 points, I said, that sounds unlikely. Yeah. Yet here we are.
Yeah.